Hello and welcome. This is Business Incorporated on Channels Television, and I'm Temple Ashaju. On the program today, South Africa's inflation eases to 3.1% in August from 3.2% in July. World Bank identifies agribusiness, entrepreneurship, apprenticeship, and employment opportunity for Ghanaian youth. And First Abu Dhabi Bank and Egypt's Post signed Memorandum of Understanding to boost financial inclusion in the country. But let's begin the show with the markets, where major markets in Africa were mostly negative at intraday, except for Nigeria's main index, which rose by 0.63%. In South Africa, the JSE declined by 0.57%, while Egypt's EGX 30 declined by 0.01%. Kenya closed negative on Tuesday. And of course, in the Middle East, all the major markets that we track were in the positive territory at intraday. Dubai's main index jumped by 0.91%, while the Abu Dhabi index rose by 0.52%. Elsewhere in the region, the Qatari index advanced by 0.80%, while Saudi Arabia's index rose 0.11%. And European stocks bounced either side of the flat line this morning as investors continue to react to the United States presidential debate and gauged the investment landscape amid the coronavirus crisis. Ashutosh Pandey has more for us from the Frankfurt Stock Exchange at this point. Hi, Ashutosh. Thank you for joining us on the program. President Trump and his Democrat challenger, Joe Biden, engaged in a major debate yesterday. How are the markets reacting to that at this point?
The markets have seen some choppy trading today. They started in the negative, in the red zone, but they didn't. They then turned for the upside, and that's because there was some positive data coming from China about factory activity, and then also some positive data from the German employment or the jobs market. Having said that, then the markets have actually turned negative since then. The debate's impact on the market was initially felt. That was because of that acrimonious debate. People felt that perhaps that's just a preview of the things to come in the future. And actually that debate has reignited concerns about perhaps a disputed vote. That is a possibility where President Trump may not actually concede defeat if he were to lose. So that's worrying the traders a little bit. But having said that, the broader issue today dominating the markets is the rising COVID-19 numbers, and that's the reason why the markets are actually in the red still. And that's also right, actually. That makes sense considering how low on substance that debate was. There wasn't really anything new there. Mostly it was backward looking, and hence there's more focus on more pressing issues by the traders.
Ashutosh, I know, yes, that there's nothing new in that debate because, again, we've had feelers from both sides before the debate. But I'm not letting you go on this conversation about the Trump and Joe Biden's debate. But there's been some Trump stocks and Joe Biden stocks. Can you tell us what that is all about?
Well, it's basically those shares which are expected to perform better in each administration. And it's not very difficult to see why. Because if you look at, say, shares of financial companies, smaller businesses, or even traditional energy companies, they are expected to do well if Donald Trump is re-elected. And that's because of his stand on climate change and his actually good regulatory scheme that he's provided for the industry, and with lower corporate tax, and that's going to bode well for these industries. So these stocks are going to do well. Now, if you look at Joe Biden, if he were to win, then stocks like the green technology stocks, green energy stocks, infrastructure stocks, also healthcare services stocks are going to do really better because here Biden believes in climate change. He does not think that it is a hoax like his like many in the Republican Party do. So he is going to spend a lot on the greener technologies, and then he's pledged to spend a lot on infrastructure. That's going to do well for the infrastructure shares. And also he supports the Obamacare, so that's good for the healthcare services sector. But having said that, a lot will depend on who controls the Congress, which party controls the Congress, and if the White House and the Congress, the Senate and the House is split between the two parties, in that scenario could actually be the best for the markets, because then that would mean that there would be checks and balances, so there won't be any extreme measures from either side.
I know that external observers like you and I, who are journalists, will continue to keep their eyes on the November election as it approaches. And that's something that a lot of other diplomats will actually be watching, and I'm sure a lot of investors. But let's talk a bit about what Reuters is reporting, that the World Trade Organization has allowed the EU to slap tariffs on as much as $4 billion of U.S. exports annually. And we understand that the tariffs are in retaliation to illegal U.S. subsidies for Boeing. What does it mean, basically, for the 16-year-long dispute?
Oh, yeah, 16-year-long dispute. So basically what has happened today, and that the news has been now confirmed by Bloomberg also, and several other agencies, that the World Trade Organization has allowed, actually, the European Union to slap tariffs on $4 billion worth of goods from the US. Now, that's part of the ongoing dispute in which the US blames and the WTO has also found that perhaps the EU was illegally subsidizing, or the US was illegally subsidizing Boeing. So that's $4 billion. Now, there was a parallel case also to it, and that was the US said that the EU was doing the same with Airbus. Now, the WTO also found that, yeah, perhaps the arguments were correct there, and they handed the US $7.5 billion award. So basically, they could charge $7.5 billion worth of tariffs on EU goods. So $4 billion versus $7.5 billion, and the EU was expecting $12 billion, for which it has just got 1/3 now. So because of this lower award that the EU has won from the WTO, this leaves it in a weaker position vis-a-vis the United States. If they were to come to the negotiating table, they haven't come to the negotiating table so far, though the European Union has been insisting the US to come to the negotiating table, because it's in nobody's interest to actually have some sort of a trade war or higher taxes at a time when the world is going through a recession. And perhaps many experts do feel that maybe it's not the right time to also slap tariffs, even if the EU has won the award from the WTO. And that many do believe that the pandemic could actually be the final, the push for both parties to actually come to the negotiating table and resolve it, because these tariffs are not good for anybody, especially during a recession, and this has now lingered on for 16 years. So they need to find a solution, and it's best if they come to the negotiating table and just find a solution there.
Well, Shitosh, do enjoy the rest of your day and stay safe ahead of our next conversation on this show. So, in the United Kingdom, the Bank of England's chief economist, Andy Haldane, has taken a swipe at the press for being too negative. Let's talk to Juliana Olayinka, my colleague in London, about this. Hi, Juliana. It's really good to see you. So, Andy Haldane has justified his attack on pessimism by arguing that the unholy trinity of risks facing the United Kingdom economy aren't as serious as you may think, and as our colleagues in the press or in the media have been publishing lately. Are the markets moved by this?
In short, no, they're not moved by Andy Haldane's comments. As you were discussing at great length in Frankfurt, European markets have squarely been focused on what's happening overseas, and obviously that chaotic debate between President Donald Trump and former Vice President Joe Biden, that's trickled down into the sentiment into European markets. But as you were saying, Andy Haldane, the Bank of England's chief economist and most importantly, Monetary Policy Committee member, was speaking at an online event. And during the online event, he really was saying that there needs to be less pessimism. He's always maintained that stance, really, that the Bank of England are able to have a really good forensic focus on what's happening in the British economy on a day-to-day basis, rather than relying on some of these scandalous headlines. He really was squarely focusing on negative interest rates. There has been lots of discussion pointing towards the fact that the Bank of England could opt for that. And he really just reiterated that that's not the case at this stage, that nothing from their last meeting's minutes suggested that this was the case. And people should focus on the fact that we're likely to rebound in Q3 with a growth of 20%. Let's have a look at the numbers. The FTSE All-Share is down 0.18%. The FTSE 100 is down by 0.30%. And the FTSE 250, the domestic market, up by 0.12%. In currencies, the British pound is down on the US dollar by 0.04%, up on the euro by 0.18%, and down on the Japanese yen by 0.07% an intraday.
Well, what I'll say is that it's actually very, very good to remain incurably optimistic, just as Haldane. But again, in contrast to Andy Haldane's upbeat outlook, our high street bank TSB has just announced large job cuts, adding to the 9,000 positions going at Shell. But how do we reconcile these, of course, with Haldane's optimistic position, which he just explained at this point?
Yeah, let's try to separate them. I believe Haldane's comments are really focusing on the negative interest rates, and there's lots of speculation about that. I don't think whether Haldane, Sunak, the Chancellor of the Exchequer, or Andrew Bailey, the Bank of England governor, have been shying away about saying that we are expecting a tsunami of redundancies at the end of October when that furlough scheme comes to an end. We've already seen it, and it is happening. Not every job can be saved here in the UK. Of course, Shell this morning mentioned that 9,000 jobs will go. We're not sure how much will be in the UK. They've got about 6,500 staff here. But High Street Bank TSB, owned by a Spanish company, have said that they are going to be closing, I believe, 164 stores or branches. This is going to affect 969 job roles. One of the unions have asked them to reconsider letting these staff go, but they said it's impossible to keep them. They've really been tracking data, tracking customer behaviour, and we've seen it really across the banking sector here in Britain. The established method is being disrupted by online. Lots of people are doing all of their banking online, and TSB released some statistics showing that pre-pandemic they had about 1,200 customers a day using their online facilities. That has risen sharply to 4,000 customers. Like most high street lenders, it is becoming a pretty crowded environment. They were having trouble pre-pandemic, and as part of their cost-cutting measures, as we're seeing, cost-cutting is becoming a buzzword, they believe that they've got to let this staff go.
Let's talk about some money-spinning issues here now. The United States casino operator Caesars Entertainment has agreed to £2.9 billion takeover of the British bookmaker William Hill. How much do we know about this deal?
Well, what we know is that the deal is done. It's just still waiting for shareholder approval. We actually spoke about this on Monday, didn't we, when it was first announced that they were in advanced talks with William Hill, and the deal has been secured. Interestingly enough, when the deal was first announced that it was on the table, that morning, William Hill, the FTSE 250 company, their shares fell by about 12% because the market didn't think that it was valued high enough. But they've obviously reconsidered their position, and they are going to accept the deal. Caesars Entertainment, quite popularly known for being a very strong presence in Las Vegas, and it's only been a couple of years since Washington has legalized online sporting betting in the US, and William Hill seemed to have monopolized on that market, particularly in some states in the South. I believe they've also got about 90 branches out there. So this is seen as a win-win deal. I believe as part of some of the terms and conditions, Caesars Entertainment have agreed to keep in place the current staffing structure and policy to at least 2022, which will come as great relief to about 8,000 staff who are currently employed by William Hill in the UK. But it hasn't been an easy year for William Hill. There's been lots of legislation put forward by the government to try and take a hold of gambling, which is a huge addiction problem that we have here in Britain. And Caesars Entertainment have stated that once they have secured this deal, they will be trying to pass on at least the UK franchise to another buyer.
All eyes are on Trump and Joe Biden election. That's where folks are going to be betting. I don't know where Juliana will be betting, actually. We'll take a break now and we'll be back with more stories, especially from around Africa. Stay with us. Still Business Incorporated. Welcome back from that short break. Well, let's move to Southern Africa now, where South Africa's annual inflation eased to 3.1% in August 2020 from 3.2% recorded in July, with food and non-alcoholic beverages, housing and utilities, as well as miscellaneous goods and services as the major contributors. Now, data released today by Statistics South Africa shows that on a month-on-month basis, consumer price inflation increased by 0.2%. And according to the report, food and non-alcoholic beverages increased by 3.9% year-on-year and contributed 0.7% to the total inflation. Housing and utilities increased by 3.1% year-on-year, while, of course, the miscellaneous goods and services increased by 6.6% year-on-year, and the annual inflation rates for goods and for services were up 2.2% and 3.9% respectively. But joining us now to make sense of these and more is Makwe Masalela, the Chief Investment Officer of Makwe Funds Managers. Thank you for joining us on the show this afternoon. Well, we know that your inflation is into 3.1% in August from 3.2% in July, was basically the main issue right there in South Africa. Is that really in line with your expectations?
More or less, but we thought it will stay around 3.2, given that on Monday we saw the PPI, Producer Price Index, going up from 1.9 to 2.4. It was a very nice surprise that it just tick slightly down to 3.1. But we need to note that we know that our Reserve Bank, they've got a target of inflation to be anything between 3 and 6%, and they're more excited when it's around the midpoint or below the midpoint of 4.5%. And so far, this is month 21, that we've seen our inflation being either on the 4.5 or below. So meaning we don't have any inflation risk for the country, and that gives at least our Reserve Bank a little bit of more room should a need arise, that they can cut interest rates further, bearing in mind that so far they've cut interest rates by almost 3% for the year.
Makwe, we know that some of the contributors include food and non-alcoholic beverages, housing and utilities, as well as miscellaneous goods and services. These are the key contributors. But let's drill down on how these key contributors actually shaped the numbers.
You know, just food and non-alcoholic beverages, they account for almost 17%, of the basket. So the minute they move, then definitely they'll have a very serious impact. And even though so far they're almost at their lowest at 3.9%, but now since this whole thing is when we started opening up our economy in August, so meaning there was a little bit of demand when it comes to those things. And especially as we know that most of the retailers were closed, most of the people were not being able to go out. So hence we've seen that people will be able to have a little bit of demand and supply kicked in. Hence we saw that ticking down.
So let's talk about the labor statistics that was released yesterday. Despite the loss of 2.2 million jobs in the second quarter, the data indicates that there was also a massive decline in unemployment. Of course, that's on the other side and pushes up employment rates in South Africa. But what's responsible for that from the research that you've carried out so far?
Yeah, remember that can be misleading if you just look at the decrease in unemployment. It's all because of the math that they've used. It means that most people were discouraged or could not go out between March and July to go out and seek the jobs, whether sending CVs or going with the brown envelopes to the factory gates, because we were under hard lockdown. So meaning that your labor population was just too small. Hence, it will show that the unemployment went down. But the clear reflection is this what we call extended labor unemployment rate, which is just around or just over 40%, because that considers everyone, even those who were discouraged to go out and look for jobs. And as you said, I mean, just to have over 2.2 million people losing jobs, and here back in South Africa, every person working on average, they are accountable for at least 3 or 5 other people that they need to support. So it's a very huge setback. And you wonder, because we had businesses during the lockdown making all the noise that they need to open up so that they save jobs. We wonder what is it that they've done to be able to save those jobs, because as you are saying, almost 2.2 million jobs were lost.
Makwe, will you say that this decline in unemployment rates is some sort of a good step in the right direction?
It's not, because that's misleading, because you had very few people looking out for jobs. People were discouraged. So we'll get a very clear picture when you look at the third quarter, because people now will be going out to try to look for jobs. So meaning you are what we call the labor force will just be more, or the labor population that you have to use in your calculation, and that will give a very clear reflection. But as it is, that number is kind of misleading, because people were unable to go out. People were discouraged to go out and look for jobs. So it's not even anything that we need to consider. We need to be concerned about the 2.2 million jobs that we have lost. We need to be concerned about what we call the extended unemployment rate, which managed to tick up.
Well, let's hope that someday at least the spending power will get a boost for everyone in South Africa, especially for the youth over there. But let me ask you, if that's your view, what's your outlook for South Africa's economy, especially in this fourth quarter of the year, which takes effect from tomorrow, Makwe?
Unfortunately, it's not looking okay, because remember, South Africa, we've been having our own problems. Even before COVID-19, the economy was already in a recession, the economy was downgraded, and we have this big problem with us here, which is electricity. As we've seen that immediately when we started trying to open up the economy, then our electricity utility, which is Eskom, which is supplying almost 95% of our electricity, started with its load shedding, and obviously that will affect businesses going forward. So other than the huge debt that we're having as a country, electricity continues to be a problem. And also we know that back home here, they've been preaching this whole issue of structural reforms, but so far we have not yet seen anything concrete. We're still waiting to see what is it that they'll come up with. I mean, we can just have a look of what is happening with SAA. As it is now, I think it's under care and maintenance. People have been waiting, hoping that the government will be able to come with the 10.5 billion or so that the rescue plan can be implemented. What I'm trying to get to is that South African economy has been struggling. It will take us some bit of time to get out of the woods, and we don't have to get to pre-COVID-19 levels. We have to get to levels where the economy was at least growing, and the economy growing in a sense that it has a very positive dent when it comes to this high unemployment rate.
Makwe, I can tell you for free that South Africa is not alone in all of this quagmire. But then let's just hope for some better days, hoping that we'll have some silver lining in sight. Makwe Masilela, Chief Investment Officer at Makwe Fund Managers. Thank you for your time on the show.
Pleasure.
Great. And a new World Bank report titled Youth Employment Program in Ghana, Options for Effective Policy Making and Implementation identifies agribusiness, entrepreneurship, apprenticeship, construction, tourism, and sports as key sectors that can offer increased employment opportunities for Ghanaian youth. Now, the report also calls for more investments in career guidance and counseling, work-based learning, coaching, and mentoring to equip young people with the skills needed for work. And the World Bank explains that although these are not new areas, the government could maximize their impact by scaling up the priority areas in existing youth employment interventions and improve outreach to the youth. And on that note, it's a wrap on Business Incorporated this afternoon. Thank you for being a part of it. I'm Temple Ashaju. Again, we'll see you next time. Bye.